I came to Washington in '75. It was during the Ford administration. We had some inflation toward the end of the '60s. There was a little bit of money production to try to get us out of the '69 recession. The inflation rate had gone up, then we fought that, and we had a recession, and then inflation did come down, but then we printed a lot of money in the early '70s. Nixon wanted very badly to get reelected, so he pushed the Fed for an expansion, and he got it. And he hit it with wage and price controls for a while, but of course those broke down. And then we ended up with double-digit inflation for the first time, I guess, since the Korean or World War II, one or the other. And that was that horrible 10.8% spike in inflation. Well, that ended in the recession of '75-6. And then we got another surge of inflation at the end of the decade, and that was finally brought down by Mr. Volcker in the early 1980s by tightening money. Look at the upward trend of the best we were doing with inflation, however. It was getting worse over time, even in the best years, until the Volcker intervention, where it really came down later. The unemployment rate was going cyclically, as you would expect, but even in the best years, we were doing worse. Instead of 3.4% in the late '60s, we're now at almost 6% in the best years toward the end of the expansion in the 1970s. Why are inflation and unemployment trending in the same direction? This was the jolt to the economics profession that got them wondering about the stability of the Phillips curve and whether or not they were doing the right thing. The monetarists had a point that if you tried to print money to boost the economy, you were probably going to mainly get price increases or inflation increases and not real output increases. But why were we getting less output and higher unemployment as a result of the inflation? That was not supposed to happen in a pure inflation. In a pure inflation, wages and prices and all other costs rise at the same rate, and there's no change in the relative burden of cost versus sales. So why in this purely anticipated inflation did we have a bad effect? What didn't adjust?
Tax brokers?
The tax code wasn't changed very much. There were some changes which we'll go into later in the course when I go blow by blow through the tax policies of the various decades. And I lived through these bills. I was on the Senate floor once for 3 weeks from 9 in the morning until 11 at night with over 1,000 amendments in 1976, and I was new to the town, and I was getting pretty tired of it all, and so were the members. But we had all these tax bills. We did dozens of changes to the tax system. Some of them were in the right direction and worked. Some of them were just froth and did nothing. But each of these amendments just dragged on and on and on. Anyway, what was going on was that the tax system wasn't adjusting for the increases in prices. And to see what that does, and here we're finally getting to the economics of taxation as it's currently viewed, I think, by the neoclassicists, let's go into how taxes affect decisions about working, saving, investing, and so forth. This is in every textbook, whether it's Keynesian or non-Keynesian, and it is the imposition of a tax, in particular an ordinary excise tax on cigarettes or gasoline or anything else you might want to tax. And think of it as a diagram of a sin tax. You don't want people to smoke, it's naughty. You don't want them to get drunk, that's naughty. The local governments used to have saloon taxes, liquor licenses, they still do, but they were called sin taxes because the saloons always generated a lot of brawls and crime, and you had to hire more police, so you put a licensing fee on the drinking establishment, and that was sort of a user fee. An early version of the user fee dating back to the 1800s, well, or earlier in Britain. Anyway, suppose you have an excise tax, and economists would all agree. Without the tax, you would be at E0. You'd be producing Q0, and you would have a price somewhere there in the middle. Now we put on a tax at a rate PC versus PP, price to the consumer versus price to the producer. Somewhere in between those two prices, the government is stepping in and taking a tax. So much per pack, so much per gallon, whatever. So the price to the consumer goes up, the price to the producer goes down, and we have a wedge, that triangular area, driven between the two prices. And because the price has gone up, consumers are buying less, and because the price to the producer's gone down, producers are producing less, so output falls. So the new quantity is Q1. The tax is the difference, PC minus PP, times Q1, the blue rectangle. And the area under a demand curve this is what consumers are willing to pay for each quantity. This is how they value the output. The price line, the supply line, under that is the cost of producing the added units. So the area under the supply curve is the cost, the area under the demand curve is the satisfaction. When you have a difference between the two curves, some quantity that would have yielded more satisfaction, more than the cost of the production, is not being made. The consumer is losing value. The economy is losing value. It's called the deadweight loss of taxation. It simply disappears. And they tend to split it into the loss to the consumer above the line and the loss to the producer below the line. These consumer surpluses and producer surpluses are not true surpluses in any way. If you go out there in the economy when the price is at P0 and the quantity is at Q0, you won't find anything to grab unless you can come up with a sort of lump sum all or nothing tax that doesn't affect the final sales prices. If you charge every saloon $100 and then say, okay, whatever you do after that, you can keep all of it, that won't affect behavior very much. But if it's an income tax where you're actually taking money out of the next dollar, this is what you get, or the next pack of cigarettes. So here I have first roughly quadrupled the tax, and the quantity falls to Q2. The middle rectangle is bigger in area than the long horizontal rectangle, so revenues have risen because the tax rate went up more than the quantity being taxed went down. What do we call the quantity being taxed? That's the tax base. And then the tax rate is that tax imposed per unit or in percentage terms on the vertical axis. So you have to worry about the rate and the base, because if the base moves, the revenues will move and you won't get your full increase. You certainly aren't getting 4 times the revenue from 4 times the tax rate. You're getting less than that because the base has fallen by, in this case, roughly 40%. Now, if I keep going and I raise the rate further and the base really collapses, that blue rectangle is smaller than the big rectangle. And ultimately, if you had a prohibitive tax that completely choked off the activity, you'd get no revenue at all. That's the Laffer curve. At a 0 tax rate, you have no revenue. But at a tax rate that totally chokes off the activity, 100% of your earnings from doing the activity are seized. You don't do any activity. And somewhere in between, not knowing quite where, you've got the maximum revenue. Is that the best point to tax? At point B, if you increase the tax, the GDP falls so much, or the quantity of smoking falls so much, that the cigarette tax yields no additional revenue. So you force some people to do less, and the government's got no revenue. That can't be the best point. The best point is somewhere around point A, where the damage from the tax, as it goes up, is more than countered, or just barely countered, by the value of the revenue gotten and whatever you're spending it on, and the pleasure people and your constituents get from whatever you're going to give them with that money. And you see that the economy here, the base loss peaks well before the revenue maximizing rate. A revenue maximizing rate is almost never the optimal tax rate. And certainly if you're beyond the revenue maximizing rate, it's silly, because you're actually losing revenue and choking off activity for no apparent purpose. This creates a tension between those who want to stamp out liquor and those who want to raise revenue from the liquor tax. So the legislatures are always willing to give the carry nations of the world a little bit of support for taxing the bad thing, but they're not going to go so far as to hurt their own revenue flow. And so the sin tax advocates who hate the sin want more, and the other people resist.